Welcome to Protea Financial, education for your business to help you be successful. My name is Zane Stevens and I'm the founder of Protea Financial. Today I want to teach you about the accounting equation. And you might ask the question, what the heck is the accounting equation? And that would be a good question. And a lot of people don't understand that accounting is fairly simple and all comes down to the simple formula of assets equal liabilities plus equity. Very simple. A equals L plus O. Your first question would be like, what about income? What about expenses? Well, pretty simple. Equity at the end of the day is your profit and loss plus your capital contributions. So equity can be capital contributions plus income minus expenses. And that makes up the third component of the accounting equation. Understanding this simplifies the process of accounting to its very basic form. In this video, we're going to discuss what is an asset, what is a liability, and we'll go into a little bit more detail about equity. A lot of business owners are truly only focused in on the daily operations and hence the question on income and expenses. But what is always overlooked is these important elements of assets and liabilities to your business. At the end of the day, the assets and liabilities give you a picture of what your business is worth. Plus, it gives you a sense of if you had to close this business down, what would be left for you as you exit. So let's start with the simple terminology of assets. Assets at the end of the day are what your winery owns. Assets represent everything your business owns and that monetary value. They're categorized into different classes known as current assets, meaning short term, and non-current assets, meaning longer term. Current assets are assets that can be converted into cash within 1 year. For most businesses, these are typically inclusive of cash and cash equivalents, how much money you have in the bank, accounts receivable, which represents money owed to you by customers for goods or services rendered, inventory, being raw materials, work in progress, and finished goods that you use to sell to your customers, as well as other assets like prepaid expenses, when you pay for that annual contract up front to receive services for 12 months. Though prepaid expenses are generally convertible to cash, some are harder to be refunded than others, but when we're talking about this type of situation of closing down the business, an insurance policy would be something, if you cancel it, you would receive back the remainder of the term of the insurance policy. Maybe not in full, but there would be a cash value to it. Non-current assets are assets that generally have a lifespan of longer than 1 year. These are generally broken into two main categories, one being property, plant, and equipment. So think about all your hard assets, the equipment to manufacture your products. You think about the building, vehicles, even things like computer equipment. The second category is known as intangible assets, which can sometimes be a little harder to value unless you purchase them. But this includes trademarks, patents, and when you're buying a business, at times you will be able to capitalize a value of the purchase price to a category called goodwill. I'm not going to go into any detail of intangibles. It is a fairly specialized portion of the accounting system. And for more details of that, I would say give it a Google, give it ChatGPT, and they can come up with a good answer for you. It's important for your business to understand what its assets are because it gives you a sense of what you own. This can be important when you're trying to raise finance through the bank or through a third-party investor because they want to understand what they're purchasing. Telling them a brand value or revenue is important, but they also want to understand what hard assets come with it. And if it is an asset, is a business that is selling inventory, it's important for them to understand how much inventory you have on hand, what the value of that inventory is, so they can calculate what that value could be in the future. Understanding your business's assets allows you to assess your liquidity, operational capacity, and long-term investment potential. We've seen many businesses meticulously track their asset values and make more informed decisions about expansion and resource allocation. It's important to understand what assets you have, especially when you're trying to make decisions on what you need to bring into your business to continue to be successful, or assets that you may need to potentially replace. If we look at the other side of the equation, we have to look at liabilities. Generally, what liabilities mean is what your business owes. What money do you owe to third parties? Liabilities represent your business's financial obligations to external parties. As with assets, they are categorized into current and non-current. Current is liabilities that are due in less than 12 months, and non-current are liabilities due in more than 12 months. Current liabilities are the ones that you're generally more aware of and operate if you're operating a business. These can be accounts payable, funds due to vendors for goods or services that you purchase from them, short-term loans, including bank loans and line of credits who are due within 1 year, or even the current portion of long-term liabilities, accrued expenses. These are expenses incurred but not yet paid, such as salaries and utilities. These are important when it comes to accrual accounting when you want to match your expenses and your revenue to the right period. Non-current liabilities are also fairly understandable, with long-term loans, including mortgages, being non-current, as well as any deferred tax liabilities. Again, deferred tax liabilities, like intangible, is a more complicated topic within the accounting space, and I would say go look for some detailed answers on Google or ChatGPT. It is very important for every business to understand what their liabilities are. Understanding your liabilities and when they're coming due is critically important in managing your cash flow of your business. Understanding your liabilities and when they're due is important for maintaining financial stability. We often advise our clients to be carefully monitor their debt levels and ensure they have sufficient cash flow to meet their obligations. Debt is important to be paid off because if you default, you run the risk of somebody going out and trying to seize your assets. We spoke about the accounting equation when we started as A equals L plus O. Another way to put it is assets less liabilities equals owner's equity. Assets, what you own, less what you owe to people, the liabilities, will give you the worth of your business, the equity. Within that equity, as we discussed, would be capital contributions, less your drawings, plus historical profits, plus current year profits. Equity represents the owner's stake in the business. It reflects a residual interest in assets after deducting liabilities. It's an important number to know when trying to value a business, and it's an important number to know if you want to bring new investors in or if an investor wants to leave the business. Equity is a crucial indicator of a business's financial strength and long-term viability. A healthy equity position demonstrates that your business is generating profits and reinvesting back into the business. It's important to understand these concepts because it is the foundation of accounting and also the foundation of your business. It is taking a complex topic and bringing it into its simplest form. At the end of the day, what accounting is trying to achieve is the accounting equation. It is trying to tell every business owner what they own, what they owe, and what the residual value of that business is. How much is left after assets less liabilities. Understand the accounting equation, understand what your business is worth.